money, 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 money. Crazy about my money. Money, 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 money. Crazy about my money.
Welcome everyone. Today, me and Kent are going to dive into some fundamental mathematical concepts that every investor should know.
That's right, Kelsey. So nothing's more exciting than talking about math problems on a video. We were lucky to have some Oak Grove teachers, Susie Welch, Karen Addison, some great math teachers. Unfortunately, not everybody has that luxury, right? And there are a handful of things that can make it much easier as investors to really understand your financial plan using some basic math.
Yeah, so let's start with the rule of 72. This rule is a quick and easy way to estimate how long it's going to take for your initial investment to double at a fixed annual rate of return.
Exactly. So very basic concept. You simply divide 72 by the annual rate of return in order to get the number of years it will take for your investment to double. So for example, say you're earning an annual return of 8%. It will take approximately 9 years for your money to double. 72 divided by 8 equals 9. Say you're earning 6% annually. Simple math, 72 divided by 6 is 12. You could assume about 12 years for your investment to double.
Yeah, it's a handy rule to set realistic expectations and for planning your investment goals.
So another important concept to talk about is dollar cost averaging. So this strategy involves investing a fixed amount of money over a specific interval or regular interval of time, regardless of market conditions. Kelsey, why would somebody want to dollar cost average?
Yeah, so dollar cost averaging, it helps reduce the impact of market volatility over time. And you do that by spreading out your investment purchases over a certain amount of time. So this means that you can buy more shares when the prices are low for a stock, and then you can buy less shares whenever a price is high for a stock. This will ultimately lower your average cost per share.
Exactly. And that's where it really shines. So you're consistently investing the same amount of money each month or each year or whatever that interval might be. And as you buy more shares when prices are low and fewer shares when prices are high, ultimately you're reducing that average cost per share.
Exactly. And to break it down a bit further, let's say you make a decision to use $1,000 each month to buy a specific stock that currently trades at $50 per share. In month 1, you could buy 20 shares, but in month 2, it increases to $52 per share. That same $1,000 will cover around 19 shares. Then in month 3, it drops to $45 a share, allowing $1,000 to buy you over 22 shares. This consistent approach ultimately helps smooth out the impact of market volatility and can potentially lead to better long-term investing returns and a lower average cost per share.
And that's why it's such a valuable strategy for investors that are really looking to build wealth over time. So many times we think about a stock price as the ultimate return indicator, right? But in many cases, that doesn't take into account the full picture of what a stock can really do. So let's talk about something called total return. Now, total return measures not only the overall performance of the stock price, so appreciation or depreciation, but also takes into account the income that's able to be generated through dividends or interest payments.
Yes, so that income can be a valuable tool in generating returns. To calculate a total return, you're going to add up all of the income generated from the investment and any capital gains or losses, then divide that total by the initial investment amount. Multiply that by 100 to express it as a percentage.
Absolutely. So total return is heavily related to our next concept, which is the power of compounding. So some really wise people, Albert Einstein, Warren Buffett, a handful of folks have all talked about, what the power of compounding is. They say it's the 8th wonder of the world. This is where time can really be your greatest ally.
That's so true. Compounding is the process of earning interest on both the initial investment you made and also the interest earned in the past. Over time, this can lead to exponential growth of your investments.
Absolutely. So let's say you invest $1,000 in a savings account with an annual interest rate of 5%. At the end of the first year, you will have earned $50 in interest payments on that $1,000 investment, bringing your total balance to $1,050. Now, in the second year, you'll still earn that 5% interest, but you're not only earning it on the $1,000, but also on the $50 interest you earned from that first year. So in reality, you actually increase that interest payment from $50 to $52.50, bringing your total balance to a little over $1,100.
In other words, each year your interest earnings are going to increase not just because of your initial investment you made, but also because you're earning interest on top of the interest you already earned.
That's a lot of interest,
That's
right?
a lot of interest.
Yeah. So this compounding effect can lead to significant growth in your investment. The longer the money remains invested and continues to compound, the greater the impact. So this is why starting to invest early and allowing your investments to really compound over time is such a crucial component to really building long-term wealth.
Yeah, so in essence, compounding is like a snowball effect. When your investment grows larger and larger, and as time goes on, thanks to the reinvestment of earnings. The key takeaway here, though, is to start investing early and consistently. Even small contributions can grow substantially over time thanks to compounding.
Absolutely. So whether you're calculating the rule of 72, you're practicing dollar cost averaging, you're figuring out total return, or really harnessing the power of compounding, understanding some of these basic kind of math concepts can really allow you to be a more informed investor and ultimately make smarter decisions about your long-term financial plan. Thanks so much. We hope to see you again soon.
Money, money, money. Money, money, money. Crazy about my money.